Something quietly changed in the global financial system at the beginning of 2026. There were no emergency press conferences, no market crashes, no dramatic headlines flashing across television screens. But beneath the surface, a shift occurred that future historians may look back on as the moment the world's monetary order began to decisively fracture. In January 2026, the BRICS alliance, Brazil, Russia, India, China, and South Africa, now joined by Saudi Arabia, Egypt, and several strategic partners, activated a new international digital settlement currency. It is known simply as the unit, and unlike many financial initiatives that remain trapped in speeches and proposals, this system went live quietly, functioning immediately for cross-border trade settlements between participating nations. This was not an experiment. It was not a pilot program. It was not a promise of something coming soon. The unit began operating as a real alternative financial rail, allowing participating countries to settle large-scale international trade without routing transactions through the United States dollar or Western-controlled banking infrastructure. For most people alive today, the dollar-based system has felt permanent. Global trade, energy markets, shipping contracts, sovereign reserves, all of it has flowed through the same financial arteries built after World War II. That system shaped the modern world so completely that questioning it felt unnecessary. Until now, what makes this moment different is not confrontation, but construction. The BRICS nations did not attack the existing system. They built a parallel one. New settlement mechanisms, new clearing processes, new financial infrastructure designed to operate outside traditional Western control. And with that, they opened access to a monetary framework that immediately serves a massive portion of the global economy. This event did not end dollar dominance overnight, but it did something arguably more important. It introduced genuine competition into a system that had functioned as a monopoly for nearly 8 decades. The implications of that shift are not immediate. They are structural, and once structural changes begin, they are rarely reversed. This is where the story truly starts. At first glance, the launch of another international payment system may not seem historic. The world already uses dozens of currencies, countless banks, and multiple settlement networks. New financial tools appear every year, most of them quietly fading into irrelevance. But what happened in January 2026 is fundamentally different. Not because of the technology involved, but because of what it challenges. Money is not just a medium of exchange. It is a system of power. Whoever controls the rails through which money moves controls trade, liquidity, and ultimately political leverage. For nearly 80 years, those rails have been dominated by institutions designed, governed, and enforced by the United States and its allies. The global economy has operated inside that architecture, whether countries agreed with it or not. The BRICS unit matters because it breaks that assumption. For the first time in the modern financial era, a coalition of major economies has created a functioning alternative that does not depend on Western approval, Western banks, or Western currency reserves. This is not about ideology or symbolism. It is about optionality. When there's only one system, participation is mandatory. When a second system exists, even if it is smaller, the balance of power begins to shift. Countries no longer have to accept every rule imposed by the dominant framework. They gain leverage simply by having somewhere else to go. This is why the unit represents more than a payment tool. It represents a structural change in global bargaining power. Sanctions, asset freezes, and financial exclusion only work when the targeted country has no alternative pathways. A parallel system does not eliminate those tools, but it weakens them by reducing their reach. The importance of this moment lies in erosion, not collapse. The dollar does not lose power because it fails. It loses power when others no longer need it for every transaction. Each trade settled outside the dollar reduces global dependence, even if only slightly. Over time, those small shifts accumulate. This is how monetary orders change, not through dramatic replacement, but through gradual competition. And competition, once introduced into a closed system, is almost impossible to contain. To understand why the emergence of the BRICS unit is so significant, we first need to understand the system it challenges. The modern global financial order did not emerge naturally. It was designed, negotiated, and enforced in the aftermath of the Second World War. At a moment when much of the world lay in ruins and the United States stood economically unrivaled. In 1944, Representatives from 44 nations gathered at the Bretton Woods conference to design a new monetary framework. Their goal was stability. Competitive devaluations, currency wars, and financial chaos had deepened the Great Depression and fueled political extremism. The solution they chose placed the United States dollar at the center of the system, backed by gold, and trusted because of America's industrial strength, political stability, and vast gold reserves. Even after the gold backing ended in 1971, the structure remained. Trade was priced in dollars. Energy markets, especially oil, were settled in dollars. Central banks held dollars as reserves. International loans, shipping insurance, and commodity contracts all flowed through dollar-based channels. Over time, this arrangement stopped feeling like a choice and began to feel like a law of nature. This system delivered real benefits. It lowered transaction costs, increased global trade, and provided a common financial language. But it also created dependency. Countries needed dollars, not because they traded with the United States, but because everyone else used them. Participation in global commerce required access to Western banks, Western clearing systems, and Western regulatory approval. This dependency gave the United States extraordinary influence. It could finance large deficits at low cost. It could borrow in its own currency. And crucially, it could use the financial system as a tool of enforcement, restricting access, freezing reserves, and excluding nations from global trade networks. For decades, no credible alternative existed. Other currencies were too small, too unstable, or too politically constrained. The dollar did not dominate because it was perfect. It dominated because there was no rival system capable of operating at scale. That assumption held for nearly 80 years, until the foundations began to crack. Every system appears stable until the moment it reveals its vulnerability. For the dollar-based financial order, that moment did not arrive with a market crash or a recession. It arrived with a political decision that sent a shockwave through central banks around the world. In February 2022, following Russia's invasion of Ukraine, Western governments led by the United States froze more than $300 billion of Russia's foreign currency reserves. These were not private assets or corporate funds. They were national savings accumulated over decades and held inside Western financial institutions, assumed to be untouchable under international norms. With a single decision, those assumptions collapsed. For the first time in modern history, a major G20 economy discovered that its reserves were not truly its own. They could be rendered inaccessible overnight, not by military force, but by administrative action. The message was unmistakable. Participation in the global financial system came with political conditions, and access could be revoked. For many countries, this was a profound wake-up call. It demonstrated that the financial infrastructure they relied on was not neutral. It could be weaponized, and if it could be used against Russia, a nuclear-armed state with vast resources, it could be used against anyone. This realization spread quietly but quickly. China took notice, so did India, Saudi Arabia, Turkey, Indonesia, and others began reassessing where their reserves were held and how their trade was settled. What had once been theoretical concerns about financial sovereignty suddenly became urgent national security questions. The issue was not sympathy for Russia, it was precedent. Once a tool is used, it becomes available for future use. Governments understood that disagreements over policy, alliances, or trade could now carry financial consequences that extended far beyond tariffs or diplomacy. This moment did not destroy the existing system, but it shattered the illusion that it was safe, neutral, and permanent. Trust, once lost, is difficult to restore. And when trust erodes in a financial system, participants begin searching for alternatives. Quietly at first, then deliberately, this was the fracture point from which everything else followed. The response to the fracture in the global financial system was not impulsive, it was methodical. Rather than attempting to dismantle the existing order, the BRICS nations focused on building something parallels, something designed from the ground up to address the vulnerabilities they had just witnessed. At the center of this effort is the unit. It is not a national currency, and it is not intended for everyday consumer use. Instead, it functions as a settlement instrument designed specifically for cross-border trade between participating states. Its purpose is narrow but powerful, to move value between nations without relying on the dollar or Western-controlled financial channels. The structure of the unit reflects this goal. A significant portion of its value is linked to physical gold held in secure vaults across BRICS countries. This is not symbolic backing. It is meant to anchor trust in something tangible, universally recognized, and politically neutral. Gold does not depend on policy credibility or promises. It exists outside any single government's control. The remainder of the unit's value is tied to a weighted basket of BRICS, national currencies. This design spreads risk across multiple economies, rather than concentrating it in one. If one currency weakens, the impact is diluted. If another strengthens, the system benefits. Together, the basket reflects the combined productive capacity, resources, and population of the bloc. This hybrid structure is deliberate. Gold provides stability. The currency basket provides flexibility and growth potential. Neither component alone would be sufficient. Together, they create a settlement tool that is both grounded and adaptive. Equally important is the infrastructure surrounding the unit. Transactions clear through systems designed to operate independently of Western banks and messaging networks. This ensures that trade can continue even under external financial pressure. The result is not a replacement for the global system, but an alternative pathway, one that exists alongside it, ready to be used when trust in the dominant framework breaks down. That optionality is the core of its power. Skepticism is natural whenever a new monetary system is announced. History is filled with ambitious financial projects that failed once theory met reality. What separates the BRICS unit from most proposals, however, is that its core logic has already been tested under pressure. Long before the unit formally went live, Russia and China were forced to find alternatives to the dollar system. Western sanctions restricted access to traditional payment networks, and reliance on the dollar became a liability rather than a convenience. In response, both countries began settling trade directly in their own currencies. By 2026, nearly all bilateral trade between Russia and China was conducted without the use of the United States dollar. Energy exports, industrial equipment, agricultural goods, and manufactured products moved through alternative settlement channels at massive scale. These were not symbolic transactions. They represented hundreds of billions of dollars in annual trade between two of the world's largest economies. This matters because it answers the most important question surrounding the unit. Can large economies trade efficiently without the dollar? The answer is already visible. They can, and they have been doing so for years. The unit does not invent this behavior. It standardizes it. Instead of relying on improvised bilateral arrangements, it provides a shared framework that can be expanded to multiple countries simultaneously. What worked between two nations can now function across an entire bloc. This transition also reduces friction. A common settlement instrument simplifies accounting, lowers currency exchange risks, and increases predictability for long-term contracts. These are practical advantages, not ideological ones. In financial systems, credibility comes from usage, not announcements. The fact that dollar-free trade has already occurred at scale gives the unit something most challengers lack. Proof of concept, it demonstrates that the dominant system is not the only system capable of handling global commerce. What turns a functional alternative into a serious challenge is not design alone. It is scale. And this is where the BRICS unit moves from being an interesting development to a structurally important one. The BRICS alliance is no longer a small grouping of emerging economies testing an idea on the margins. With its recent expansion, it now represents close to half of the world's population. Billions of people live in countries that are either members or active partners. This demographic weight alone gives the system immediate relevance. It is not launching into a hypothetical future market. It is launching into an existing massive economic ecosystem. Economically, the numbers are just as significant. The combined gross domestic product of BRICS nations exceeds $28 trillion, and that figure continues to grow faster than most Western economies. These countries control large portions of global oil production, natural gas reserves, agricultural output, rare earth minerals, and industrial manufacturing capacity. In other words, they sit at the center of the physical economy that global trade depends on. This matters because settlement systems gain strength through usage. Every transaction settled through the unit reinforces its legitimacy. Oil sold from Russia to India, manufactured goods shipped from China to Brazil, agricultural exports flowing from Brazil to Egypt. Each of these transactions deepens the network effect. As volume increases, costs fall, confidence rises, and adoption becomes easier for the next participant. Momentum in financial systems is rarely driven by ideology. It is driven by incentives. If trading within the bloc becomes smoother, cheaper, and less exposed to external pressure, businesses and governments will naturally prefer it. Over time, what begins as optional becomes routine. This is how parallel systems grow, not through confrontation, but through convenience. Scale provides gravity, and once enough economic mass begins moving through a new set of rails, it becomes increasingly difficult for the old system to pull it back. The most important consequences of a monetary shift are rarely the ones announced at launch. They emerge slowly in markets and policies that appear unrelated at first. The BRICS unit is no exception. Its deeper impact lies in the second-order effects it creates across assets, institutions, and strategic behavior. One of the most direct effects involves gold. Because a portion of the unit's value is anchored to physical gold, sustained use of the system creates ongoing demand for the metal. This is not speculative demand driven by investors seeking short-term gains. It is structural demand from central banks that must hold gold to support settlement volumes. As more trade flows through the system, more gold must be allocated to maintain credibility. This dynamic matters because global gold supply grows slowly. Mining output increases incrementally, while large portions of existing gold remain tightly held. When steady institutional demand meets limited supply, upward pressure builds over time. The result is not sudden price spikes, but persistent repricing. Another effect appears in reserve management. Central banks traditionally hold large amounts of dollars to facilitate trade and stabilize currencies. If even a portion of trade shifts toward alternative settlement systems, the need to accumulate dollars diminishes. That does not eliminate the dollar's role, but it gradually reduces its centrality. Financial institutions also adapt. Banks, insurers, and logistics firms follow transaction flows. As settlement volume increases outside traditional channels, supporting infrastructure develops alongside it. Payment systems, hedging instruments, and legal frameworks begin to form around the new rails. Perhaps most importantly, policy behavior changes. When countries know they have options, their negotiating posture shifts. Monetary flexibility becomes a form of strategic leverage. This does not create immediate confrontation, but it alters incentives quietly and persistently. Second-order effects are powerful because they compound. They do not rely on belief, they rely on behavior. And once behavior changes at scale, markets adjust whether policymakers acknowledge it or not. No monetary system succeeds on design alone. Trust, coordination, and long-term discipline matter just as much as infrastructure. This is where the BRICS unit faces its greatest challenge, not from external pressure, but from internal complexity. The BRICS alliance is not a unified political entity. It is a coalition of nations with different histories, priorities, and strategic interests. Some members are long-standing rivals. Others operate under vastly different political systems and economic conditions. Managing a shared settlement framework across such diversity is inherently difficult. China and India, the two largest economies in the bloc by population, have unresolved border disputes and compete for regional influence. Russia and China cooperate strategically, yet historically they have been wary of each other's dominance. Brazil's democratic institutions and economic priorities often diverge from those of more centralized governments within the group. Smaller members risk having limited influence over decision-making in a system shaped by much larger economies. These tensions matter because monetary coordination requires compromise. Questions inevitably arise. Who determines adjustments to the currency basket? How is gold custody verified and audited? What happens if one member faces a severe financial crisis or political upheaval? Is support guaranteed, or does each country absorb its own losses? History offers cautionary lessons. Even tightly integrated regions have struggled with shared monetary frameworks. The European debt crisis exposed how difficult coordination becomes when national interests collide during economic stress, and those countries shared far more institutional alignment than the BRICS nations currently do. Western analysts often point to these fractures as the unit's potential breaking point. The assumption is that internal disagreements will eventually slow adoption, weaken trust, or stall expansion. That risk is real, but it is not decisive. Shared vulnerability can be a powerful unifying force. The same concerns that drove these nations to seek alternatives may also motivate them to maintain cooperation, even when tensions arise. Whether that balance holds over decades remains uncertain. And that uncertainty is central to understanding what comes next. Forget everything you've heard about a sudden dollar collapse or a financial apocalypse in 2026. The real story behind the BRICS unit is much more interesting and much more realistic. It's not about an explosion, it's about erosion. For nearly 80 years, the entire global financial system has been built on one single idea. There is no alternative to the US dollar. Well, that idea is officially out of date. The BRICS unit isn't designed to destroy the dollar overnight. Its real power is simply that it exists. Think about it. When you only have one option, you have no choice. But when a second viable option appears, everything changes. The game is no longer the same. The very existence of a parallel system, even if it's used selectively at first, permanently alters the balance of power. Countries can now negotiate differently, manage their reserves differently, and even structure trade deals in new ways. Over time, these small decisions add up. They reshape the entire financial landscape without needing a single dramatic crash. This isn't about dividing the world into two camps, Team Dollar versus Team BRICS. Instead, we're moving into a more complex, layered system. Some trade will still use dollars, some will use regional currencies, and some will use new systems like the BRICS unit. Countries will simply choose what's best for them based on cost, convenience, and political risk. For the United States, this means the end of an era where its financial dominance was taken for granted. The exorbitant privilege of the dollar-like easily financing huge deficits and wielding powerful sanctions gets weaker when the world is no longer totally dependent. American influence won't disappear, but it will face real competition for the first time in decades. For the rest of the world, this is a huge deal. It offers a path to greater financial independence and a way to reduce risk from decisions made thousands of miles away. History teaches us that monetary systems don't last forever. They evolve as power and trust shift. The launch of the BRICS unit is a clear sign that this evolution is happening right now. The monopoly is over. The competition has begun. And once the rules of global finance start to change, they almost never go back to the way they were. Understanding this shift isn't just for economists anymore. It's essential for everyone. Thanks for watching, and be sure to subscribe for more insights.